Hello everyone and welcome to my YouTube channel. Today we're going to talk about the global dollar shortage. What is happening? Emerging markets are losing foreign exchange reserves at an absolutely record pace. This is unprecedented, and what we have seen in the months of March and beginning of April might as well continue throughout a few more months as the global economy slows down, and we also see that the lockdown because of the pandemic leads to further ramifications in the economy, particularly a weakness in global growth and trade. But let's understand why there is such a global shortage of US dollars. To start with, emerging markets have been increasing significantly in the last years their US dollar denominated debt. Why did they do this? MMT people tell us that they could issue all the debt that they want in local currency and issue all the money that they want without a problem. Well, the reality is that in the last 8 to 10 years, the vast majority of these economies have had to issue in US dollar denominated assets, fundamentally because there is no real demand for local currency risk, either from domestic or from international investors. There is some, but not enough to support the level of growth of these economies. Second, throughout this process of the last 10 years, what many of these emerging economies have done is to massively increase both their fiscal and their trade deficits, so twin deficits. In those times, that was relatively easy because there was cheap money and low interest rates and plenty of demand for emerging market risk. However, what is changing now is that the cycle has turned. So, on top of lower commodity prices, lower export volumes because of the global trade growth collapse, lower demand from domestic and international investors of emerging market risk, but furthermore, much lower demand of emerging market local currency risk, what we see right now is the risk of a sudden stop. What is a sudden stop? A sudden stop means that despite the fact that the Federal Reserve is massively increasing its balance sheet, and despite the fact that the Federal Reserve is also lowering rates and increasing money supply significantly, the reality is that it's not doing enough to address the massive global shortage of US dollars, which is estimated at about 13 trillion and moving into $20 trillion. China, for example, has about $3 trillion of foreign exchange reserves. That is quite strong. However, that covers almost what it has in terms of US dollar debt denominated liabilities. So what happens is that as those reserves fall, as they have been doing in the past years, and dollar denominated liabilities rise, the shortage of dollars increases. That is happening in many of the exporting economies. While the market was exuberant and optimistic about global growth, the global carry trade that took cheap dollars and invested it in emerging economies was more or less carrying those imbalances and disguising those risks. But that has gone. Now what we are seeing is an environment in which even if the Federal Reserve increases money supply, the reality is that most investors, both domestic and international, would like to put their money somewhere else than in higher risk, high volatility markets, such as many of the emerging ones. And what is happening is very simple. On one side, their central banks are trying to defend the currency, selling dollars. Bad idea, because one, the currency continues to collapse. Two, the weakness in reserves increases. Second, these countries are facing about $2 trillion in maturities in US dollar denominated liabilities in the next 2 years. Therefore, if the trade growth environment and the commodity price environment does not improve, it is going to be very difficult for these economies to address the commitments that they already have, let alone to talk about any new issuances to deliver some growth. And there is no way that the International Monetary Fund or the World Bank addresses such a massive shortage of dollars. So we find ourselves in a situation in which even if the Federal Reserve decided to go absolutely bonkers in terms of increasing money supply, most of that money would continue to be invested back into the US economy or developed economies because the risk in emerging markets is simply unacceptable. So what do they have to do? What they have to do probably is to take much more aggressive measures to address their fiscal imbalances and start to attract capital so that the wave of outflows starts to move back into emerging economies, and the challenges that they are seeing right now are addressed properly. It's not an easy task, to be fairly honest, in an environment in which both the commodity cycle is negative, the macro cycle is negative, but also because storage is filling up rather quickly, so overcapacity is added into the picture. It's a very challenging monetary and fiscal situation that more liquidity is not going to address very, very quickly. Thank you very much for following. Remember to subscribe and leave your comments on the section below. Thank you very much.